All right, we have more changes unfolding in the U.S. economy and in the U.S. housing market. Changes that have another major investment bank updating their price forecast after the higher for longer reality is continuing to settle in. This comes only days after Morgan Stanley did a complete 180 and began warning their clients of the potential headwinds facing residential real estate next year. So we'll look at what Goldman has to say, why they're updating their forecast now, how big of a change it really is, and we'll look at mortgage rates as well, because in this new piece of theirs, they don't just talk about home prices, but they also change their rate outlook. And it's a surprise with just how much they've shifted toward higher for longer and with where they see mortgage rates going and staying. But before we get started, press the like button and consider subscribing. It's just a click of the mouse beneath the video, completely free to do. It helps me out, and I appreciate your support. So interest rates, folks. After weeks of nonstop selling, a complete bond sell-off, and the 10-year Treasury yield breaking 5% for the first time in 16 years, what happens? The CTAs take over and all of those pre-programmed trades begin. It's really anyone's guess what would have happened once the 10-year hit 5%. And it looks like a lot of big investors decided to cover their bets, and you really can't blame them. After the last 10 months of carnage, bond markets, have been facing. But in the big scheme of things, folks, nothing's changed. The fundamentals are exactly the same as they were last week. It's also pretty wild when you think about it, just how badly treasuries were hammered, even with all the volatility that's playing out geopolitically these past few weeks, a massive regional conflict brewing in the Middle East. You'd think with all of that going on, investors would flee to safe haven assets like treasuries, but they weren't. Well, we did see some upside in gold, but here's where we are right now. The 10 years now at 4.95%, yield curve reinverted a bit, and all eyes now shift toward next week's FOMC meeting, where Jerome Powell and the other voting members of the Fed decide the fate of the U.S. economy. Goldman Sachs now predicting another pause for November, but still says they believe one more 25 basis point hike is coming in December, and most other investment banks are saying the exact same thing. So where does that leave us? Well, it leaves us in good shape because as we just saw these past few weeks, it's not so important that the Fed keep raising the overnight rate. What's important is that they don't cut rates as bond yields and mortgage rates, really rates across the board, everything from our credit cards, which have an APR 29% now, to refis, to HELOCs, lines of credit for your business, all of it can keep moving higher independent of what the Fed does. And to explain why we have more room to run, take a look at this. Term premium, the extra buffer or premium to entice buyers to buy this debt, has soared, folks, through the roof. This spike, by the way, these past couple weeks is incredible. I spoke about this on X this morning, how it's like about damn time that investors are compensated for this kind of duration risk. But keep in mind, the long run average is 161 basis points. We're currently at 37. That's 0.37%. That's it. Sure as hell better than negative term premium, which is where we were just a few months ago. But what this means is normality, rationality is coming back to the market, folks. If you're going to take this type of risk, tying your money up for 10 years, there best be a high enough yield for that to make sense, right? Well, is there? I personally don't think so, not yet at least. And mortgage rates work the exact same way. Currently 8% for the average 30-year fixed rate mortgage, right? Already having drastic effects on the housing market, and it's beginning to make all of these analysts a bit nervous. Everyone and anyone in the industry is now showing their true colors. We showed what the NAR's chief economist said in a press release last week, all but demanding that the Fed cut rates. And why? Why is he so adamant? Well, it's his job to be a cheerleader for real estate agents, and he's realizing that at these levels, it removes such huge pockets of home buyer demand. For example, first-time home buyer cohort, all but priced out of the market right now. In 2022, 70% of all first-time home buyers were between 24 to 32 years old. 70%. Well, that age group is virtually wiped out now, erased from the housing equation, as their income is just too low. The median income for that cohort's $54,000 a year. You need to earn more than double that to even qualify for a mortgage today, like you see on this chart. So the potential buyer pool has been cut in half, folks. Like you see here, 49% of all home buyers in 2022 earned less than $99,000. Well, you need $115,000 just to qualify. That's a big chunk of demand gone, poof. And the little demand that's left is due to home builders selling their new home stock and eating the cost of these higher rates, continuing to gift rate buy downs. We have brand new numbers from the U.S. Census Bureau released yesterday that prove this is exactly what's happening. Take a look at this. New home sales spiked in September. Not home sales in general, but new home sales, brand new houses. Look at the spread between mortgage rates and new home sales. This light blue line should be falling, not rising. They are eating the cost, these big home builders. But here's the thing. Even if they save you like 100 basis points, you're still looking at a 7% mortgage, which means you still need to earn 115 grand to qualify. That's a problem. And there's only two realistic ways of fixing that problem. Either mortgage rates come down or home prices come down. Eventually, one of them has to fall. And according to a new piece by Goldman Sachs, they say the exact same thing. And it's forcing them to rethink their housing market outlook. The title of the piece that they put out 2 days ago is Higher for Longer in the 2024 Housing Outlook, published on October 22nd. And before we look at this, realize Goldman is bullish on housing. They've always been bullish on housing and on home builders as well. They're still bullish on home builders, actually. Here's how they open the piece, writing this. After the 1-2 punch of skyrocketing mortgage rates and normalizing pandemic-fueled demand led to the sharpest slowdown in the U.S. housing market since the 2008 financial crisis, and the recent jump in mortgage rates and the prospect that they are likely to remain elevated for the foreseeable future present headwinds to the economy's most interest rate sensitive sector, that being the housing market. Now, they may sound a bit bearish there, but realize they are realistically bullish. Don't let it fool you. The housing market moves like a turtle, folks. So when you read about forecasts and they're only, a few points here or there, it's because the housing market doesn't move like the stock market. You can buy and sell shares of public companies in seconds, where to buy or sell a house takes you months. So here's what they say about mortgage rates. We'll get into their rate forecast first, then we'll cover home prices right after. Also, if you want access to the system, to our research database, you can visit our website, rjtalks.com. It's in the description of this video. Here's what they say. Sustained higher rates will weigh on housing turnover. Interest rates have risen across the board in recent months, and especially so at the long end. Mortgage rates have increased by almost 2 percentage points since their trough in early 2023, with about half of the increase coming since this summer. Our strategists expect mortgage rates to remain elevated for the foreseeable future, dipping to just under 7% by the end of next year. Now, they go on to chart this out, where they see mortgage rates going. They say by year end of 2025, so by January 1st, 2026, essentially, they believe that the average 30-year fixed rate mortgage will be at 6.2%. In 2026, folks. That's pretty high for Goldman. 6 months ago, they were saying something very different, anticipating the overnight rate to be back at 2.8% by 2026. So things have changed. Higher for longer has been soaking into reality. Now, what about home prices? Well, keep in mind, before we look at this, most of these investment bank forecasts base their forecasts on current numbers, right? So for example, at current inventory levels and at these mortgage rates, we forecast home prices will reach X or Y number. That's what they do. That's why that Morgan Stanley report that we spoke about the other day was so interesting. It looked at the impact of home prices as inventory begins to normalize. And they essentially said for every 1% increase in inventory, we could see a 1% decrease in home prices in 2024. That's a big deal. Now, Goldman's not so dramatic, and they don't touch on inventory with their forecast, but they go on to say this. Home prices likely to decline this winter before rebounding only modestly in 2024. Our model suggests that home prices are likely to continue increasing for the next couple of monthly readings, owing in part to the Case-Shiller Home Price Index's delayed release time and 3-month moving average design, before slowing sharply and turning negative into year end. Thereafter, our model projects a rebound to below trend home price growth by December of next year, Year over year, we're forecasting 1.3% home price growth as rates decline modestly but remain at elevated levels. So what they're saying is that by year end of 2024, the S&P Case-Shiller will show year over year home price growth of just 1.3%, which is not good for the housing market, folks. Even if their forecast is correct, adjusted for inflation, home price growth is negative in 2024. But again, this is if inventory and rates were to stay where they are right now. You'd end up seeing a slow grind down in prices, is essentially what they're saying. So the open question comes down to inventory. Will there be a hard enough landing to usher in a period of forced selling? Well, it's debated. There's analysts and economists that say yes, others that say no, obviously. One that I put in higher regard than most is Michael Arnett over at B of A, who comes down on the side of hard landing. As there's headwind after headwind hitting our economy right now. It's just a matter of lag time. In my opinion, if the Fed doesn't lose their spine and they continue down this path, just a matter of when the lag time runs out. And these higher rates, tighter monetary policy, tighter lending standards, QT, all catch up with enough of us to cause the labor market to crack and to see a jump in unemployment. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.